أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم. Our lesson today will be about Islamic insurance, which in Arabic is known as Takaful. Now, as we start our lesson, these are the objectives of our lesson today. So, number one, that is by the end of the session, learners should be able to articulate the definition of Takaful and its purpose as a cooperative insurance mechanism in Islamic finance. Number two, explain the core principle underlying Takaful, including cooperation, mutual assistance, and the prohibition of interest, riba. Number three, identify and compare the various types of Takaful, such as family Takaful and general Takaful, and explain their specific functions and coverage. Then, number four, describe the different structures of Takaful operations, including Wakalah and Mudarabah models, and outline the implication for participants. Then number five, understand the regulatory environment governing Takaful in different jurisdictions, including the role of Shariah boards and relevant legislation. Then lastly, analyze the key differences between Takaful and conventional insurance model, highlighting ethical consideration and financial mechanism. So let us start the first part. So as usual, we normally start with definition of terms. So number one, what is the definition of Takaful? Like what comes to your mind when you hear this word Takaful? So Takaful is an Islamic insurance concept that is based on the principle of mutual cooperation, risk sharing, and solidarity among participants. That is in brief what Takaful is all about. So number one, there is the element of mutual cooperation between the participants, that is between the company and the insurance company and the people who have subscribed to the what? The insurance company, the ones who normally, the individuals who normally pay the premiums. And number two, there is the element of risk sharing between the company, okay, and the insured. Then lastly, there is the element of solidarity. The term Takaful is derived from the Arabic root word kafala, which means to guarantee or take care of one another. Unlike conventional insurance, where the risk is transferred from the insured to the insurer, Takaful embodies the idea of participants pooling their resources to protect each other against specific risk. So there is the element, and remember in our last lesson, we were talking about the element of risk transfer in conventional system and risk sharing. So the Islamic Takaful is based on the principle of risk sharing. Now, what is the purpose? What are the purposes of Takaful? So Takaful aims to achieve the following key objectives. Number one, there is risk sharing. So Takaful promotes a collaborative approach where participants share the risk instead of transferring them. Number two, financial protection. Takaful provides a safety net for participants against unforeseen events. So for example, you are a driver, you have a car, you never know when you will get an accident. So the best thing is to go and insure your vehicle. Then we have social welfare. Takaful fosters social cohesion and communal support. That is, it encourages participants to contribute to one another's welfare, reinforcing the importance of community over individualism. And this is very important in Islam, the importance of community. And that is why Allah says in the Holy Quran, وَتَعَاوَنُوا عَلَى الْبِرِّ وَالتَّقْوَى وَلَا تَعَاوَنُوا عَلَى الْإِثْمِ وَالْعُدْوَانِ وَكُنْتُمْ خَيْرَ أُمَّةٍ. So there is the element of community, there is the element of working together, helping each other. Then lastly, Sharia compliance. Takaful products are designed to comply with Islamic law, Sharia, meaning They avoid elements such as excessive uncertainty. You'll not find the element of gharar and interest, which is riba, because they are prohibited in Islam. So these are the key purposes of takaful. Now, what are the benefits of takaful? Number one, ethical investment. Takaful emphasizes investment in Sharia compliant areas, aligning with the ethical values of Muslim participants. For example, participants in a takaful plan can feel assured that their contribution are not supporting industries like tobacco, alcohol, armaments, which may conflict with their values. So there is the element of ethics, akhlaq, community focus. That's the second benefit. A strong sense of community and collective responsibility is fostered as each participant helps support one another in times of need. So participants help each other. For example, a takaful scheme's ethos encourages a supportive community where members are motivated to contribute, knowing their funds are helping fellow participants rather than a profit-driven insurer. Number three, there is the profit sharing. Takaful participants benefit from any surpluses in the fund, leading to a potentially lower cost of coverage over time. For example, if a takaful participant's contributions result in a surplus at the end of the year, they may receive a portion of that surplus as a bonus, lowering their effective contribution for the next period. Then number four, there is the element of transparency. Takaful operators are required to maintain transparency about fund management and how contributions are utilized. For example, regular reports on fund performance and claims expenditure are typically provided to takaful participants, promoting trust and confidence in the system. Now, what are the components of takaful? Takaful consists of several key components that define its operational structure. So number one, in takaful, we have the participants, and these are individuals or entities that join the takaful scheme, contribute to the common fund. Number two, we have the contribution or tabarru. In Arabic, known as tabarruat. Participants make contribution to the takaful fund, which is often referred to as a tabarru. These are not considered premiums as in the conventional insurance, but donations intended to help others in times of need. Number three, takaful fund. The pooled contribution creates a fund from which claims are paid. The fund is managed by the takaful operator in accordance with Sharia principles. Then number four, Sharia governance. A Sharia board oversees the operations to ensure compliance with Islamic law, providing guidance on product design and fund management. Then number five, there is the claims process. When a participant faces a covered event, they can submit a claim to access funds from the takaful pool for compensation or support. So these are the basic components of takaful. Now, to the most important thing. What are the principles of takaful? What are the principles of Islamic insurance? Number one, mutual cooperation. And this is what I was saying before at ta'awun. And it's very clear in the Holy Quran that Muslims need to help each other in times of distress. That is why Allah says, وَتَعَاوَنُوا عَلَى الْبِرِّ وَالتَّقْوَى, and help each other. وَتَعَاوَنُوا عَلَى الْبِرِّ وَالتَّقْوَى, and we should help each other in doing good deeds. وَتَعَاوَنُوا عَلَى الْبِرِّ, and we should help each other in matters related to taqwa, being cautious of Allah. So the first principle is mutual cooperation, which is ta'awun. The principle of mutual cooperation is foundational to takaful. Participants agree to work together. That's the key word. They agree to work together to support one another in times of need. Each participant contributes to a common fund. And in return, they have the assurance of financial assistance from the collective pool when they face a covered risk. For example, imagine a group of 100 individuals who each contributes $100 to a Takaful fund. Now, the total fund will be $10,000. If one participant suffers a covered loss, such as a fire that destroys their home, they can claim a portion of this fund to help recover from loss. The costs are shared among the group, emphasizing the community spirit. Number two, the second principle is risk sharing. In Takaful, risks are shared among participants rather than transferred to a single entity. Each participant understands that they are part of a community where the risk of one are borne by all, aligning with the Islamic principle of solidarity and responsibility. Tahammul al-mas'uliyah. For example, consider a family takaful plan where 50 families contribute to a fund intended to cover unforeseen medical expenses. If one family incurs significant medical bills due to an illness, the cost can be covered by the Takaful fund without placing the financial burden solely on the affected family. Instead, all families share the risk because they are all contributing to the same fund. That is the second principle, which is risk sharing. Number three, contribution, tabarru. Participants in a Takaful scheme make contribution known as tabarru, which are treated as donation rather than premiums. This contributes to the Takaful fund that is used to assist participants in need. The contributions are made voluntarily and participants are aware of how their funds will be utilized. So in a general Takaful scheme, participants may contribute $200 annually as tabarru. The money is pooled together to form a fund for claims. If a participant faces a loss from a natural disaster, they can claim assistance from this pool amount. Importantly, the contribution is not a fee for service, but rather a contribution to a communal cause. Another principle is Sharia compliance. All Takaful, and I repeat again, all Takaful operation must comply with Islamic laws and principles. This means avoiding activities and investments that are considered haram, prohibited, such as those involving interest, riba, gambling, maisir, and excessive uncertainty, gharar. A Sharia board is typically established to oversee the compliance of Takaful operations. A good example is a Takaful company may invest participant contributions only in Sharia compliant assets, such as real estate or ethical stocks. For instance, it will refrain from investing in businesses that sell alcohol or engage in practices considered unethical by Islamic standards, ensuring that all aspects of Takaful product are aligned with Sharia principle. Then the fifth principle is surplus sharing. If the Takaful fund generates a surplus, the amount remaining after paying claims and operational costs, this surplus is shared among participants in accordance with predefined agreement. This sharing fosters a sense of community and cooperation. For example, suppose a family Takaful fund has a total income of $100,000 from contributions, but incurs claims of only $70,000 in a given year, leaving a surplus of $30,000. Depending on the terms agreed upon at the onset, the surplus could be distributed back to participants based on their contributions or reinvested for future growth of the fund. The sixth principle is transparency and fairness. A key principle of Takaful is transparency in operation and fairness in dealings. Participants should be fully aware of how their contributions are managed, how claims are processed, and the terms governing the Takaful arrangement. For example, before joining a Takaful plan, potential participants are provided with a detailed explanation of the product. They receive information on how contributions are utilized, the process for submitting claims, and the conditions for receiving benefits. This transparency ensures that participants enter the arrangement with full knowledge and understanding. The seventh principle is claims process. The claims process in Takaful should be clear. And when you're talking about claim, that is if you are inflicted or if you suffer a loss, what is the process of being compensated? So if a participant experiences, for example, a car accident, they submit a claim to the Takaful operator with documentation of the incident. The operator processes the claim according to the predefined guidelines, assesses eligibility based on the terms of the policy, and issues compensation from the Takaful fund. This process emphasizes the cooperative nature of Takaful while ensuring that participants are treated fairly. Now, what are the types of Takaful? This is the next part of our lesson. Number one, you have the family Takaful. We have the general Takaful, health Takaful, investment-linked Takaful, micro Takaful, travel Takaful. Now, let us start with the first one. Family Takaful, also known as life Takaful, is designed to provide financial protection and savings benefits to families in case of the death or disability of a breadwinner. That is if you're having a family. And for example, the father who is the breadwinner dies, then you'll be insured by the Takaful. It combines insurance with a saving component. For example, a participants pay annual contribution to a family Takaful plan over 20 years. In the event of their death during this period, the beneficiaries receive a lump sum from the Takaful fund, assigned to ensure their financial security. If the participant survives the term, they may receive the saving accumulated plus any surplus generated by the fund. So that is the family Takaful. Number two, general Takaful. General Takaful covers various non-life risks, including property, vehicle, and health insurance. It operates similarly to conventional insurance, providing compensation for losses or damages incurred due to specified events. For example, participants contribute to a general Takaful fund that covers risks like fire damage to property and automobile accident. If a participant's house is damaged by fire, they can file a claim to receive compensation for the repair costs from the Takaful fund. The health Takaful, that is the third type of Takaful. Health Takaful provides coverage for medical expenses incurred due to illness or injury. This type of Takaful may cover services such as hospital stays, surgeries, and outpatient treatment. For example, a participant enrolls in a health Takaful plan and pays monthly contributions. If they are hospitalized due to a serious illness, they can claim expenses related to their hospital stay and treatments, which will be covered under the Takaful fund, thus easing the financial burden associated with the healthcare cost. Number four is investment-linked Takaful. Investment-linked Takaful combines life coverage with investment opportunities. A portion of the contribution goes towards providing insurance cover, while the remaining portion is invested in Sharia compliant investment funds. So, for example, a participant opts for investment link family Takaful plan, contributing $2,000 monthly, and from this amount, $100 is allocated for life coverage, while the remaining $100 is invested in ethical stocks or real estate. The participant benefits from both life coverage and potential investment growth, which can be accessed after a specific period. Now, we also have another type of takaful, which is micro takaful. Micro takaful is aimed at low-income individuals or communities who may not be able to afford conventional insurance products. It provides affordable coverage with simplified terms. For example, in a rural community, and when you're talking of a rural community, it's in areas where people are poor, they cannot have access to finance, money. A micro takaful plan is introduced, where participants contribute as little as $5 per month. These funds offer basic coverage for health emergencies or accidents, allowing low-income families to protect themselves against unforeseen risk without burdensome costs. So when you're talking about micro, it is specifically for people who don't earn a lot of money or people who don't have a job. So they contribute $5 every month, and suppose there is a problem, then the $5 they have been contributing, they'll go to the Takaful fund, remove it, and fund them. Then we have the travel Takaful. This travel Takaful, for example, sometimes you are planning to go for Hajj and you don't have enough money. So, but if you've been saving in the travel Takaful, the money in the travel Takaful can be used to do what? To fund your travel. So travel Takaful provides coverage for risk associated with traveling. So not only the Hajj, but sometimes there are some risk associated with the travel. Maybe you're traveling with the bus. If anything happens to you, you get an accident while traveling, or you are traveling with a ship. If it sinks, for example, in the ocean. So travel Takaful provides coverage for risk associated with traveling, such as trip cancellation, loss of baggage, or medical emergencies while abroad. Or maybe you're traveling and you lose your luggage, you lose your bag, Or for example, you're traveling and then your trip is canceled. Who is going to pay that money? It's the travel Takaful. Now, on to the next part of our lesson is about the models of Takaful. What are the models of Takaful? So when you are talking about the models of Takaful, you have the work model, we have the Mudarabah model, and we have the hybrid model. So we have three models of Takaful. So number one is the Waqf model. So what is the Waqf model? In this model, contributions are pulled into a perpetual endowment Waqf fund dedicated to mutual assistance among participants. The fund is managed by a Takaful operator, which also contributes claims according to the agreed terms. So when you're talking about Waqf, we find that there are contributions that are pulled into the Waqf. For example, you might be in Somali, Masalan, and there is a Waqf. So this Waqf means that there are people who normally contribute to the Waqf, like every month, they put $100, $50, So for example, participants contribute to a Waqf fund that aims to support members in times of need. So there is a Waqf, group Waqf. Maybe we are 20, So we decide that we are going to contribute $50 every month. And that if one of the members is faced by a problem, then we will take some money from the works to help the member. So if a participant faces a financial burden due to an accident, mathalan, they can receive support from the work fund, while the principal amount remains intact for future participants. So this is number one, work. Like 20 people, they come together, they decide to be contributing $20 every month. And if one of them, for example, gets an accident or is faced with a problem, they take some money from the work to help their brother. Then number two, we have Mudarabah. That is the profit sharing model. So this model involves a partnership where one party provides capital and the other manages the fund. The Takaful operator is the one who manages the fund. So profits from investments are shared accordingly to a pre-agreed ratio, while losses are borne only by the capital provider. And of yesterday, we already talked about this. So it is just the same thing. Like we have Rabbul Mal, which is the investor in this case, provides some money to the Mudarib. And the Mudarib, in most cases, is the entrepreneur who is having some skills. Then the hybrid means mushakkal. Hybrid models combine elements of both work and mudarabah, allowing for more flexible risk management and investment opportunities. So for example, a Takaful provider employs a hybrid model whereby contributions are directed into a work for mutual support purposes, while a portion is also invested in mudarabah. So we have some money in work for helping the members, and some portion of the money is also invested. So it's a combination of the two. Then we have also another thing that is related to the contribution and subscription mechanism in Takaful. That is how do people contribute? Or if you want to join a Takaful, what are the things involved? Number one, there is al-musharaka. There is what is known as participants' contributions. Each participant makes regular contributions, known as at-tabarru. So you can agree, like every month, we are going to contribute like $10, $15 to the Takaful fund. These contributions are pulled together to create a fund used to do what? To cover the claims. So that is the first thing. The participants, they do what? They contribute. Number two, fund management. The Takaful operator manages the contributions, using part of the fund for operational expenses and investing the remainder. So suppose we contribute, like there is $100 in our what? In our Takaful fund. How are we going to manage it? You know, so some money can be used for operational expenses, some money can be used for investments. Now, what is the claim process in Takaful? Claim process means, for example, if we are having a Takaful fund, we are 10 of us, and I get an accident. So I have to go to the Takaful fund. I have to claim something. So what is the process? Before I am compensated, before they help me, what should I do? So number one, initiation of claims. Participants must submit a claim following a loss event. So you have to submit a claim. For example, my house has been burned down. I was involved in an accident, including relevant documentation detailing the occurrence and associated costs. So the details of everything has to be very clear. Number two, assessment of claims. The Takaful operator reviews the claim against the term of the policy, validating its eligibility and determining the amount due. So the Takaful operator will evaluate your case. If maybe your house is burned, he is going to evaluate what percentage of your house was burned. What losses did you incur as the result of your house getting burned? Then there is the next process, which is approval and payout. Once approved, the operator disburses the compensation from the Takaful fund, ensuring timely assistance for the participant. Example, after experiencing a residential fire, somebody in the Takaful fund, his house gets burned. A participant files a claim with the necessary evidence, like photos and fire department's report. The Takaful operator assesses the claim, approves it within a stipulated time frame, and lastly, disburses the funds for repairs from the Takaful fund. Now, on to the next thing. There is what is known as the governance in Takaful. When you're talking about governance, the Islamic insurance, they normally have majlis, al-majlis al-Shariah. The majlis has a responsibility of ensuring that all the activities of the Islamic insurance fund are as per the rules and regulations and the principles of Islam. So Takaful operations are governed by both local and international regulatory frameworks aimed at ensuring financial stability, transparency, and fair treatment of participants. So that is the main objective of the regulatory framework. Number one, they always want to ensure that there is financial stability within this Islamic insurance, and there is also transparency. Transparency means that financial statements, financial records are shared, so you can know the financial health of this Islamic insurance and fair treatment of participants. Regulatory bodies often set guidelines regarding licensing, capital requirements, risk management, and consumer protection. For example, in Malaysia, the central bank issues regulations specific to Takaful operators outlining the capital adequacy and solvency requirement they must meet to operate effectively. Now, compliance with Shariah. Compliance with Sharia standard. So why is it important for this Islamic insurance company to follow the Sharia principles? Why is it important? So compliance with Sharia principle is crucial in Takaful. It's very important for Islamic insurance to follow the Islamic principle, to follow the Sharia. Why? To ensure that products are aligned with Islamic law and ethics. This includes avoiding transactions involving riba, which is interest, gharar, excessive uncertainty, and haram, prohibited activities. So it's very important for all the Islamic insurance company to abide by Islamic rules and regulations, to ensure that they don't engage them in things that are haram, things that bring some elements of gharar, and investing in avenues that are prohibited in Islam. Now, what are the issues and challenges facing Islamic insurance? Of course, this is just a brief. This is a summary of the Islamic insurance. I think you will have a course. There is a course. I don't know if you've covered it. There is a course on Islamic insurance. So when we shall be covering this course, we will go into details. But in our lesson today, we're just highlighting the important things in Islamic insurance. So what are the challenges facing this Islamic insurance? Number one, regulatory challenges. So limited regulatory framework in some regions can lead to inconsistency in Takaful operations. making it difficult for operators to navigate compliance and oversight requirements. Also, the lack of clear guidelines concerning the definition of takaful versus conventional insurance can create confusion among consumers and regulators. So, for example, a country like Kenya, which is not an Islamic country, but we have some Islamic insurance. We have Takaful in Kenya. But the Central Bank of Kenya is the one that is regulating Islamic Takaful. So sometimes you can see how it's very difficult. And the Central Bank of Kenya requires from the Takaful to engage in some activities which have interest. So that can be very challenging if the country is a non-Islamic country. Number two, operational challenges. Insufficient understanding and awareness of takaful among potential participants can affect market penetrations. So most of the participants, they don't have enough information about what is takaful. What are the principles of takaful? So the lack of awareness about Islamic insurance is also a challenge. So those are the those are the two key challenges facing Islamic insurance. We have regulatory challenges, we have operational challenges. Of course, we have other types of challenges which are related, for example, to human resource, the personnel. We don't have enough experts in Islamic insurance. Not many people are specialized in Islamic finance. So that in itself is also a challenge. Now, the last part, takaful versus conventional insurance. What is the difference? We have Islamic insurance, we have takaful. What is the difference between the two? What happens in Kufar's insurance and what happens in our Islamic insurance? Number one, fundamental differences. Takaful is based on the principle of mutual assistance, cooperation, and risk sharing. So the Islamic insurance is based on at-takaful. It's based on at-ta'awun, wa ta'awanu ala al-birri wa taqwa. That is the objective. That is the principle of Islamic insurance, risk sharing. But when you go to the conventional insurance, in contrast, conventional insurance operate on a risk transfer model. That is, for example, if you are having the insurance company and the insured party, the insured party will be paying premiums. And if the insured party gets the accident, then everything is transferred to the insurance company. The insurance company has to pay everything. And on the flip side, if the insured party pays premiums every month and they don't get the accident, what will happen? So that is the first key differences. So here we have risk sharing and we have risk transfer there. Number two, profit distribution. In takaful, any surplus from the fund after claims and operational expense is shared among participants based on the predefined agreement. So in takaful, for example, if you are 5 people and we have like $100 in our takaful fund, and one of us gets a problem. So from the $100, maybe we can use $50 to help our brother. Then the other 50, we are going to divide it among ourselves. Or the other 50, you can decide to invest it, and if there are profits, we divide or share the profits based on agreed term. But on conventional insurance, profits in conventional insurance primarily benefit shareholders. Policyholders may or may not receive dividends, and typically surpluses remain with the insurance company. So in conventional insurance, you find that only the shareholders benefit. But the policyholders, they can or they cannot benefit. Sometimes, like I was telling you, I have a car, and maybe I can get accident or I cannot get the accident. But every month, I pay the insurance company $2, $2, $2, such that when I get accident, they can compensate me. But if I don't get accident, they take all the money, it will be with them. Shariah compliance. So Takaful policies must adhere to Islamic law, ensuring investment and operations are Sharia compliant. But this includes avoiding industries like alcohol, gambling, or interest-bearing investment. But in conventional insurance, they don't have akhlaq. Conventional insurance does not need to comply with any religious law. They are not abide. They cannot abide to any whatever religious law, and may invest in any industry deemed profitable. So if it is khamr, they want to invest in, they can go to invest in khamr, you know. Now, so that is the end of our lesson. So we've been talking about Islamic insurance today, and we've talked in detail about what is Islamic insurance, the importance of Islamic insurance, the components of Islamic insurance, ila ghayri dhalik. So please, if you have any question, you can ask. So we still have 2 more lessons remaining. You still have two more lessons remaining. Then your last lesson, you'll be doing a quiz. You'll have a quiz. So next week, we'll have the 2 lessons remaining. Then you will do a quiz. So in our next lesson, I will give you the instructions about the quiz. Okay? So that is all. Is there any question?
Thank you. Thank you.
No. Okay.
Yeah, no. Understand, we understand.
Okay, inshallah. So inshallah we'll meet next week, inshallah.
Inshallah. Inshallah.